All right, so let's talk multi-unit ownership and scaling. And so what you may realize as you go through the process is depending upon the franchise you buy and your goals, there's a high likelihood that you will need more than one territory or more than one location in order to accomplish your goals. So what does that look like? How do you scale your franchise ownership? How do you scale to multiple units? How do you, if your goal is to grow something substantial, how do you do that? So let's dive into what that looks like overall in the concept of multi-unit ownership. So how do you scale your franchise business and portfolio? Multi-unit ownership is quite simply owning multiple units or locations. Now, most people naturally consider multi-unit to be more risky, but it can actually be the opposite. Multi-unit can be a way to diversify your risk in your franchise portfolio. And the risk could be from geography, local competition, and other factors. And so think about it like investing into stocks. Well, if you're invested in 3 stocks, well, you have 3 different ones that now could go up or down. Same thing with owning multiple territories or locations. Because in every franchise system, you have top performers, average performers, and low performers. And owning multiple locations allows you to spread out that risk, assuming you buy the right franchise. There can be other advantages as well. Another way is owning multiple brands. There are parent companies like Neighborly who owns over 15 different home services franchises. And there are many owners who own multiple territories and multiple brands as well. Greg Flynn, the billionaire who started Flynn Restaurant Group, is the largest franchise operator in the world. He owns approximately 2,600 Applebee's, Taco Bell's, Panera's, Arby's, Pizza Huts, and more. Now that's an extreme example, but once you learn franchising and how to operate and scale, you can continue to do it vertically through the same brand or horizontally through other brands. Now, the first thing to know is what is your outcome, aka your goal. You may not need or want to scale to multiple locations, and really depending upon the business you choose and how it performs, that will drive your decision. Don't make the mistake to grow just for growth's sakes. Owning a business is a balance between your financial goals and your lifestyle goals. The reward with more locations is the opportunity to make more, but it also means more locations, more employees, more debt, etc. This is why you must start with the end in mind. It's something we dive really deep into in our Zero to Profitable franchise system, getting clarity on the end picture. Now, how exactly do you scale? How does it work with employees, managers, funding, etc.? Well, it depends on a lot of factors. Is it service or retail based? What's the average sales per unit? And I'll explain why buying the right franchise from the beginning is so important to scaling or not scaling and being as efficient as possible with your time and money. AKA working harder, not smarter. So let's say your goal is to make $200,000 in profit, pre-taxes, right? Before you pay any taxes. Scenario number 1, you're in a service-based franchise with an average of $1 million gross and 20% net. Again, this is just an example scenario. So that's $200K net. But forgive the typo there, but you still need to account for your debt service if you took out a loan. If your loan is for $200,000, let's round up to a loan payment of $3,000 a month, which is $36,000 for the year. If you subtract your $200K in profit minus your $36,000 in debt payments, then you're left with $164,000. Then you'll probably leave at least 15% of the profit in the business account as a cash flow buffer. So $164,000 times 15% equals $139,400 in take home. So if your goal is to have $200K take home, in this scenario, you would need to own and operate 2 territories. In a service-based franchise, then maybe it's only another $75,000 to get the second territory up and running, with the majority of that being the second franchise fee. These, again, are just hypothetical scenarios. So if your loan was for $200,000 and you put 20% down, then you had startup cost of $250,000 plus $75K. You have a total of $325,000. So for $325,000 in two territories, even if your second location does 25% less in sales than your first, which would be $750,000, that would put the two combined at $1.75 million in annual sales. And at 20% profit margin, that's $350K net. And if you round up the debt service to $50,000 for the year, that's $300K after debt service. Then let's leave a higher buffer of 20% in the business bank account, since you're running a higher operation, a bigger operation, and the take home then would be $240K. Right? So hopefully that scenario is helpful for you, just to spell out like what scaling actually looks like when you really start to break down and play with some of the numbers. Scenario number 2, same goal of $200K pre-tax. You open a retail location this time with average sales of $750,000. We already talked about the average profit margin on generally retailer food being 0 to 15%. So if your profit margin is 15%, $112,500 a year, cost to get open $375,000, you have an equity injection of 20%. The loan for $300,000 is $4,000 a month. And the cash flow after your debt is $64,500. You put 20% aside and take home $50,000. Now, in order to hit your $200,000 goal, you need 3 or 4 locations which don't have cost efficiencies in scaling. Each location is $375,000 a pop, because you need to build out each location every time. So retail can be more semi-absentee, but it takes a lot more capital, debt, and storefronts unless the average sales per location is exceptionally high. Now, in scenario number 1 of $1 million in gross sales and $200K net, that's not going to happen overnight. It's probably not going to happen in year 1 either. Most people are impatient. They want overnight success, so they never get started in the first place. The sooner you start, the sooner you get the momentum and growth started. So let's say your path looks like year 1, you do $500K in sales and $75K in net. And even that may be ambitious. There may be some people that just barely break even on year 1. I'm just giving you an example. Year 2, $650K gross, $120K net. Year 3, $1 million gross and $200K net. So the best way to grow your empire is to let time and growth compound. Think about the United States of America. We didn't get here overnight in terms of where we are. Think about where you are in your career right now, how much money that you're making in your career. In year 1 of your career, I would imagine you were probably making significantly less than you are today. So I'm not sure why people get into business wanting that level of success, why they want year 3, year 5 money in year 1. It didn't work like that in your corporate job, so don't have that as the expectation in a business. So let's say you own one franchise location and it's retail. At one location, you have a manager running the location, and the success and operations of your business is highly dependent on your manager. What happens when your manager leaves? Do you have an assistant manager? Maybe. Maybe your business can't support the labor cost of multiple managers. So how long does it take to hire another manager? Who steps in the meantime? With multiple locations, you can have a manager in each location. If one manager leaves, then you can temporarily have your stronger manager cover 2 locations. You also then become tactical in using your locations as a way to develop other employees under the manager. That way, when ready, can be put in as manager at other locations when the opportunity arises. So you're building from the inside, promoting from the inside. Then once you have enough locations, you can hire a regional manager to step in and oversee the multiple location managers, something like this. You've got you as the franchise owner, then you've got the regional manager who is reporting to you, and then you have the store managers who are reporting to the regional managers. Right? And so this is the example in a service-based franchise. So let's say you have you, the franchise owner, and then let's say you have a general manager who reports to you, and you also have someone managing the admin and finance, maybe operations overall. Depends on the skill set of the general manager. Sometimes your general manager, you're hiring someone who is a sales-focused general manager, marketing-focused general manager. Maybe you have someone who is a operations-focused general manager. It really depends on what your specific skill set is and what you want to balance out. So, and then let's say that under the general manager, you have a lead tech or supervisor manager that reports to the GM, and then you have a sales manager that reports to the GM. And then underneath those, you then have multiple service techs and multiple salespeople on your sales team. So this is just an example of what it could look like as you're scaling and growing your operation. In a service-based franchise, you are likely not going to have an operation like this with one territory, although it is possible. Because I have taken a look deep into some franchises that can produce over $1 million a year in one territory. And in that case, you are having multiple salespeople, you are having multiple techs or people in the fulfillment or installation, etc. So let's talk about acquiring neighboring franchisees. Remember when we talked about resales? Well, often in the franchise space, resales don't hit the public market because the neighboring franchisee who is already in the system will buy it. Now, this is something that's unique to the franchise space, which is access to off-market deal flow. Sometimes the best way to get access to franchise resales is to already be in the franchise system as a franchise owner. This means you want to take the approach of building relationships with neighboring franchisees instead of seeing them as competition or enemies. I know it sounds ridiculous, but it happens. An example of this is a friend of mine who got his start buying 2 resale territories, and he now owns 5. Each of the additional ones that he acquired were neighboring franchisees. Another franchisee that I know currently has 1 location he's been operating. His neighboring franchisee, who is a top performer in the franchise system, already let him know he's planning to sell in the next few months, and he is going to give him first dibs to buy. Now, when buying resales, it's important to do it the right way. This means getting profit and loss statements, bank statements, tax returns, point of sale and payroll reports, copies of leases. Make sure you're using a purchase agreement, using an escrow company. I could literally do an entire course on resales because that is just a whole nother animal. But there are other ways to scale when you're growing your franchise empire, and we won't dive into the weeds as it's really beyond the scope of this program. But other options are potentially investor groups where you're raising capital, or you just buy in with investor groups. Some of the folks that buy some of these huge franchises that cost $3-4 million to get open, that's what a lot of them are doing. You can do partnerships. With those partnerships, you could have an operating partner, one who's actually operating the business. Maybe you're the one that's financing it. There's all sorts of ways to structure it. You can actually go out and raise capital in a formal or informal way. You can become a master franchisee. A master franchisee, we already talked about what a master franchisee is, and you can become like a regional director or area manager as well. So there's all sorts of ways that you can scale. Next, and let's go ahead and talk about selling. So once you've built up your empire, you've built up your business, what does that look like once you're done, right? So we'll talk about that in the next module.